After watching this video until the end, you are going to understand everything that you need to know about synthetic indices. So here's what you are going to learn. Number one is, what are synthetic indices? And I'm going to show you the different types of synthetic indices that you need to know, then that you can trade. And also, can the broker really manipulate synthetic indices prices? This is one of the biggest questions that people have about synthetic indices, and the pros and cons of trading synthetic indices. I'm going to show you if you really want to choose synthetic indices or if you really want to leave them or stay away. And also, I'm going to give you the top tips that you need to profit from synthetic indices. So let's start off with, what are synthetic indices? Synthetic indices is just indices that simulate real world market, but these indices are computer generated. So let me explain this a little bit further. So if you look at this chart here, in this picture on the screen here, you can see that these are people in a betting shop, right? So these are people in a betting shop, and you know, if you have ever been to a betting shop, you know what happens in there. There's a corner where there's some people who are looking at a small screen there, at some screen there, and they are looking at what is called virtual football. And this type of football, it only plays for 90 seconds per match, right? So these games are computer generated, right? Which means the betting house or the bettor cannot know the result before the match happens, right? So this is exactly what happens with synthetic indices, right? So synthetic indices are computer generated, but they simulate what happens in the real forex market. Like, they follow the support and resistance, they follow everything in technical analysis that you can do in the real world market. But you have to know that these markets are computer generated, which means every result that comes out in the synthetic indices trading is not coming from the real world market. It's coming from what the computer is predicting for you at that moment, right? So let me explain this a little bit further so that you can understand, right? So let's say you are playing a FIFA game, right? Let's say you are playing that FIFA game, and you want to you want to simulate the match between two teams, right? You know that you can simulate the match, and the match is going to be played without you being involved, but you cannot predict the result of the match. That is simply what synthetic indices does. So when you are placing trades on synthetic indices, you're just betting on matches that on the market that is moving, right? So let's say you place a buy on a volatility indices. You're going to see that if the market goes up, it simply because the computer you've predicted, and you've generated numbers to push the price is higher. So the supply and demand of synthetic indices is not contributed by real people making placing trades, but it's all from the computers, right? So it's kind of a software, right? So can the broker really manipulate the synthetic indices? Because if I start talking about it's not a real market, so now you are thinking that the broker can really change what is happening and take your money. But think about this. There's maybe the broker that is offering synthetic indices, for example, Deriv, there's got maybe 2 or 3 million people trading. So do you think that Deriv will change the whole market for your $10 trade? I don't think so. So can the broker really manipulate the indices? Well, what happens is, with the synthetic indices, they are generated from a cryptographically secure random numbers, right? So these cryptographically secure random numbers are created by a third-party software, so that you and the broker cannot know what happens. Now let's talk about the different types of synthetic indices. So we have got the volatility indices and the boom and crash indices. We have got the step indices, the range indices, and the jump indices, right? These are the types of indices that you can trade, and let me get deep into each and every one of them, and let me explain how these work. We start off with the volatility indices. So the volatility indices is just an index that measures the volatility, right? It's just an index that have different volatilities, right? It's just a move just like any other market, but if it have got different levels of volatility, and also it have got constant volatility per each and every level. So let me explain. Let's say you are trading the volatility 10 index. You are going to be trading even in the morning, in the afternoon, in the evening, in the night, right? In the middle of the night, or even tomorrow morning, but you are just trading the same level of volatility, right? So because for most people, what happens is, if you go into the forex market, right? If you go into the forex market, now I'm jumping into the pros and cons, but I'm not gonna go deep into that. But if you go to the forex market, you can see that there's sometimes that you can trade, and there's sometimes that there's no volatility. The market is just ranging between some levels, and you cannot implement your strategies, and it's very, very frustrating, and you end up placing very little trades. But if you trade synthetic indices, right? If you trade like volatility indices, you are going to see that as long as you are trading the volatility 10 indices, the volatility, the level of volatility is the same in the morning, in the afternoon, in the evening, in the night, right? If you're trading volatility 100, the same level of volatility is going to be the same. So the difference between them is that the volatility 10, you've got only 10% of the volatility 100 index, right? The volatility 100 is the most volatile of these indices. It moves a lot, right? If you have a huge account, if you know what you are doing, if you trade the volatility 100 index or the volatility 75 index, you're going to make a lot of money, right? But if you have a small account, you have got you don't have much of the experience, you have a small account, I would advise you to start off with the volatility 10 index, because it have got only 10% of the volatility. It means it doesn't move a lot, right? Which means your account can be a little bit safe. You can place small trades and get small gains, right? Because it's, for me, I believe that forex is just a game of probabilities, right? You have to lose some, you have to win some, right? It's not like you have to win 100% of the time. There's nothing like that in forex. If you ever see someone telling you that they've got a 99% win rate strategy, even on this YouTube, I probably can tell you that that person is lying to you. Because what I know is, when I place 100 trades, I can win 60 trades and lose 40 trades. But what I make sure is my wins are bigger than my losses, right? Because that is the most important thing in trading, right? Let's talk about other indices, right? The boom and crash is simply an index that makes some kind of a funny pattern, right? It makes small ticks, small ticks, small ticks, and then one huge spike, right? It makes a series of small ticks and one huge spike. In most of the time, what happens here is it makes like 500 tricks, and then in every 500 tricks there's an average of one huge spike, right? That's why they call crash 500. So if they say crash 1000, you have to know that in every 1000 ticks there's an average of one spike, right? So you have to know that. If you look at the chart right here on the screen right now, you can see that there is a small series of small ticks and one spike, small series of small ticks and huge spikes, right? As you can see that here we have 3 spikes in a row. This happens sometimes because what they say is one average spike, which means there can be 0 spikes, there can be 1 spike, 2 spikes, 3 spikes, maybe 4 spikes. This is an average, right? This is an estimation. This information is not from Deriv, or it's not from other traders, right? This is just an estimation from MetaTrader, the trading platform that records this data, right? So there's 4 types of spikes. There's 4 types of boom and crash indices. We have got crash 1000, boom 1000, crash 300, and boom 300, right? You can trade these, and I've got other tutorials that teach you how to do that. I will leave the link in the description. Now we have got jump 10 indices. We have got jump 25. These are called jump indices, right? This one what they do is, it's just like the volatility indices, right? They have different types of volatilities, right? If you master jump 10 indices, you are going to see that there's lower volatility there. The market doesn't move as much, right? It's safe for small accounts. And if you have a huge account, you know what you are doing. Maybe you want the jump 100, because the volatility in the jump 100 is bigger than the volatility in the jump 10 index, right? So there's a for example, this is they say in this index you have got a 10% volatility and 3 jumps per hour on average. So this is jump 10, right? So jump 10 have got an average of 3 jumps per hour. So this 3 jumps, what happens is, when it makes small ticks as the market moves with ticks, right? So it's if you watch this line, this price line, you can see that it will be making some ticks, say 1 2 3, and then if this is an index, it can say 1 2 3 4 and say boom, 1 2 3 4 boom, right? So this is how this moves, right? There's some kind of a pattern, right? So you can see that maybe it's much easier for you to trade this, because you already know that this is going to happen, right? You are no longer like predicting from nowhere, like in the forex market, right? I'm not saying the forex market is bad. I trade the forex market. I like to trade the forex market, but I've seen that synthetic indices have become maybe better, because I have flexibility. I know I can stick to technical analysis. I'm gonna talk about all those things in the pros and cons, so stay tuned until the end of this video. Let's move on to some indices that we have. We also have the range indices and the step indices, right? So the range indices is really some indices that I look at and I say, how can I really make money from this market, right? So look at these guys. These indices, what they do is they simply have got some ranges, right? They move and they create some ranges. And once in a while they will break that range. So they will obviously make this range, and once in a while they will break that range, right? So for example, this is the range 100, right? So you might be wondering, where am I looking at when I look this side, right? So let me show you what is happening there. I have a big screen right there, and I'm seeing this presentation so that I can really explain this to you. So if you look at this, there is a range, and then once in a while they break past this range, right? So this is called a range index. So you have to know that once it enters a range, it's going to stay in a range for a while, but it's sooner or later it's going to break that range. So you don't know what is going on, but sooner or later that is going to break that range, right? So these are the types of indices, right? If you want to learn step by step each and every index, you want to understand all these indices, I have got a full guide on my website, tradingwithtan.com, that will show you everything that you need to know about these indices, explaining each and every one of them. So I will leave the link in the description below. So make sure after watching this video, check the description of this video, because there's some very, very important links in there. Now let's talk about which brokers offers synthetic indices, right? This is a huge question, but the truth is there's only one broker that I know that offers synthetic indices, and the broker is called Deriv, right? Deriv is the only broker that offers synthetic indices. I'm not gonna go deep into everything about Deriv, right? If you go to my website, I have got a review about Deriv. I will leave the link in the description. If you want to watch the video version of that, I will also leave the link in the description below. Let's move on to the pros and cons of trading synthetic indices. What are the advantages and disadvantages of trading these synthetic indices? And we are going to start off with the advantages, right? Number one is high leverage and tight spreads. Leverage is two things in trading. It's a double-edged sword, right? Leverage is good for good traders, and leverage is bad for beginner traders. I want to say that because what happens with leverage is, if you leverage your account with too much leverage and you don't know what you are doing, you are always going to blow the account. So you have to understand something about leverage. You don't want huge leverage. But in synthetic indices, there's some type of options that I can play around if I have large leverage, right? I would trade the lower volatility indices. Like I can trade the volatility 10, right? I can trade like the jump indices 10, right? It doesn't move much. So since I have got a high leverage, I can balance that so that my account is safe if I have a small account, right? But the good thing is they've got very, very tight spreads, right? Because these are computer generated. These spreads are not affected about how much demand or how much supply is there. Because in the real forex market world, the supply and the demand, it plays some kind of a role in if people are wanting to buy and people more people are wanting to buy and more people are wanting to sell. There's some things that happens with the spread and all those things like that. But in synthetic indices, what happens is the computer is always going to generate moves. It doesn't matter if there's more buyers or more sellers in the market. It's just going to generate these moves according to how the program was like what did they say, was programmed, right? Okay, I'm just doing some jokes to keep you guys interested. If you're liking this video, make sure you click that like button. If you are new to this channel, smash that subscribe button, and let's keep moving. Number 2 advantage of trading synthetic indices is 24/7 trading. These are computer generated, as I said. So that means the weekend doesn't affect your trading. There's nothing like overnight trades, like holding overnight, all those things. Like traders know how painful it is to close on a Friday on a loss side, because you don't know what happens on the Monday morning, right? The market can even worsen your trades, right? So in synthetic indices, it's always running Monday to Sunday, 24/7, and the same constant volatility. If you're trading boom 1000, it's going to be boom 1000, and what is going to be happening is the same, right? So you can see that there is going to be always some patterns that you can see trending and going, right? But one thing that I want you to know is if you're trading synthetic indices, make sure you're flexible enough to change strategies. If you see that this strategy is no longer working, you have to change it, right? But you don't have to change in one day. I'm not saying change the strategies every day. I'm saying if you trade like for 3, 4, 5 months and you see now your strategy is now getting not getting enough results as it used to, you have to change that strategy. Because what happens, this is computer generated, right? So these numbers can change. Anything can happen in terms of patterns, support and resistance, all those things, right? So I put a lot of strategies on this channel. You can check out, click on the channel and go to our videos and see the list of videos that we have about strategies, and subscribe if you are new so that you won't miss any of them. The number 3 advantage is not affected by news. These are computer generated, right? Guys, as you already know, how many times have you ever been in a trade and the non-farm payroll, right? The non-farm payroll is coming and you are in a trade. How do you feel as a trader? You know that in the next minutes, I'm gonna go very rich or I'm gonna go very broke, right? So you cannot really plan toward events, right? And the non-farm payroll is not the only event that affects, right? There's Trump tweets, right? Now that Trump is not the president anymore, but there was Trump tweets, and there's all those things that could affect the real market, right? But synthetic indices, they are computer generated. They are always running in the same manner, and they are doing the same thing that they did maybe yesterday, a day before yesterday, right? And also you have to know that they can be traded with technical analysis only, right? This is the advantage. If this is not affected by news, that means I don't have to worry about fundamental analysis. I don't have to worry about sentimental analysis. All I have to worry about is technical analysis, candlestick patterns. support and resistance, all those things around technical analysis, these are the only thing that I need to master, right? So that means I can narrow down my learning curve and focus on technical analysis so that I can get results. Now this is a lot of advantages, but let's look at the cons, the disadvantages. Number one, leverage is dangerous for beginners. Yes, because most people think that if you're telling people about forex trading, you have to tell them that you're always going to make money. No. This is not what I do on this channel. If you have been following from day one, right, I've been telling you that you are going to lose some trades, right? And in those losing trades, that's where most people fail in forex trading, because most people, they are not focused on what is going to happen in a long term. Most people, they don't want to lose. Traders hate losing. I hate losing, right? But I have to accept it because I chose to become a trader. So I have to lose some trades. But my job as a trader is to balance my losses and wins so that my wins are bigger than the losses. It's a game of probability, guys. So I wrote about all these things in our ebook, right? You can check it on the description below if you want. I have got this book, and this book is going to show you how to change your mindset as a trader, right? So let me tell you that leverage is dangerous as a beginner, because as a beginner you can make a lot of money in a short period of time, or you can lose a lot of money in a short period of time, right? So leverage is good or it's either bad, but for beginners, I recommend you, if your account have got big leverage, stick to the low volatility indices, right? And number two, disadvantages I can say is it's not a real market, guys. So I cannot assure you that people are transparent. I don't know what happens in big industry business, right? I don't know what they do, the broker and the synthetic indices, the synthetic indices provider, right? I don't know what they can do behind our back as traders, right? As traders, there's a lot of traders. Almost all the trader is researching about, can the broker really manipulate, right? So one piece of information that can go wrong about manipulation can break the broker's reputation. So that's why I think that the broker cannot risk manipulating our trades, because once we get that information as traders, the broker is out of business, right? But we have to know that this is not a real market, right? We cannot say, okay, this is a point where most people cannot keep buying, right? Because sometimes when people are trading in the stock market, in the forex market, they can say, okay, the Facebook stock have not gone below the $100 mark, right? So it's never going to go down. So you have got more confidence. But in synthetic indices, you are going to see it's just a computer generated market. So anything can happen. Now let me give you the tips that you need to profit in synthetic indices. Number one is start small and build up, right? Most people, they go into the market and deposit a lot of money, right? If you have money, okay, it's okay to deposit a lot of money, but if you don't have the knowledge that is required, I don't think there's any need of depositing a lot of money, because you're not going to make money. This is not a magic. This is not an automated game. It's not a magic trick. It's something that most people are doing, and there's competition between me and you, right? Because you have to know that if you enter the forex market and you place a buy and I place a sell, there's a chance that when you lose, I take the money, or when I lose, you take the money, because the forex market is an over-the-counter market, right? The broker is just connecting my trades to your trades to other people in the world side. So the traders that are making money, they are making money because some traders are losing money. You have to understand that. So you have to know these things. You have to understand. People say, okay, I'm not going to learn about forex trading. These people are lying to us, but I am just gonna go into the market and do it myself. Okay, you can do that, but I personally think that you need to know these things, right? If you don't understand candlestick patterns, it simply means you cannot trade candlestick patterns. Maybe when the time you sell in the market, I see a candlestick pattern that's saying there's price rejection, so I have to buy. Then I buy and I make money, and you say the broker have manipulated the trade and I've lost money. But the truth is you didn't understand what was happening in the market, right? So what I'm saying is you have to learn first and start small and build up. Once you build, there's a lot of things that you're going to build. You're going to build up your confidence. You're going to build up your skills. You're going to build up your chart drawing skills. You're going to build up your risk management tools, discipline, all those things that you need to become successful in forex trading. You're going to do it once learning and doing it with your small accounts, right? Number 2 is manage your money wisely, right? Your number 1 goal in the forex market, I'm always going to say that, and traders hate that. Even trading educators hate what I say here. Managing your money is way better than making your profits, because your job as a trader, according to me, is to protect your capital. If I deposit $1,000 in the market right now to trade for the next month, my number 1 job is to make sure that I don't lose that $1,000 in the next month. I'm not focused on the profits. I'm focused on protecting that money, and I know that if I'm able to protect $1,000 until the end of this year, it's not going to be $99. It's not going to be $999. If I'm able to protect that money, that means at the end of the year it's going to be 1,200, 1,300, depending on what I do, right? So most people will say, okay, I want to double my account in 24 hours. That's cool. That's what most people want. But I have never seen a business where people can double their bank accounts in 24 hours. Because if there was someone who can do that, that person would be the richest person in the world. If you teach me how to double $10 today and do it again tomorrow, do it again day after tomorrow for 10 straight days, I would say you are a genius, right? But what happens is, this is a game of probability. So manage your money wisely, right? I'm standing firm on that statement. Manage your money wisely. Don't just say, I'm going to win. Okay, I'm going to protect my account, right? When you place your trade, first you have to know when to exit before you start thinking about when are you going to how much are you going to make. Where are you going to place your stop loss, so that if this trade doesn't go where you want, you are going to exit and accepting that small loss, because you know that if you keep your losses small, your wins big, you are going to blow up and make money, right? Guys, let me tell you one secret, right? I don't want to make this video very long, but let me tell you one secret. I'm in a trading business and internet marketing, on all those things. Most people, for every 100 people you market to, there's an average of 1 to 2 people that buys from you. So how much work do you put to get 100 people and just get 2 sales? Think about how much work people are putting to get 100 people and getting 2 sales. But for you as a forex trader, I don't know, how do you think you are special that you can just want to get into the market with $20 and double it every day and make money? That's not going to happen. Of course you're going to lose, but what you want to make sure is you want to make your losses small. Once you see that the market is not doing what I want, get out of that market and wait for the next trade. Once the market goes in your direction, hold up that trade. Don't hurry to exit the trade. Don't say, the market is gonna reverse. Let me just take this $5. No, hold on up to maybe 1 to 2, 1 to 3, 1 to 2, 1 to 3 risk to reward ratio. If you are risking $1, make sure that when the market goes into your way, you don't exit that trade until you reach $2 in profit. Because what happens is, if you get 100 trades and you get 50 trades win and 50 trades loses, your 50 wins should make sure that it covers all the 50 losses and it gives you a profit. That's how you become a profitable forex trader. Number 3 tip is, don't let your emotions overwhelm you. don't be afraid to enter the trade. If you see a setup, just go enter the trade, right? Because once you build the mindset that I'm gonna lose some and I'm gonna win some, you get over the thinking of what if I lose this one, right? Because you know that you are going to lose some and you are going to win some. So it's important to know that trading is just a way of, it's a game of probability, right? The next tip is create a trading plan and follow it. Guys, to be honest with you, most people trade without plans. But for me, the reason why I don't give signals to my to people that I work with in trading, people that I help with trading, is I know that those people can never follow my trading plan, because I can go for 1 to 2 days without placing a trade. But some people, they don't want to go for 30 minutes. Look, whenever they look into the market, they don't want to get out of the charts without placing a trade. And this is a huge problem. We're going to talk about that. If you want me to do a live video, guys, explaining, talking about all these things to you about the trading mindset, click, put the comment below, right? So what you want to do is create a trading plan. If you don't see any setup that is in your trading plan, don't trade. It's not a crime to go for a day without placing a trade. That's why I say, if you're a beginner, don't try to trade full time. Don't try to make a living from trading. Why? Because you are going to be pressurized to place trades, because you want to earn that money to pay your rent house, right? But if you're trading like it as a part-time trader, you can afford to go for a day without placing a trade. You can afford to just ignore the market for 1 or 2 days to refresh your mind, and then you come back later after maybe 3-4 days and place trades, right? Then create the next thing is master technical analysis, right? Technical analysis, if you want to trade synthetic indices, is one of the things that you need, right? Because technical analysis is simply everything about synthetic indices, because there's no other way that you can analyze synthetic indices which is not technical analysis, because there's no fundamentals, there's no sentimentals, there's only technical analysis, right? So master technical analysis so that you can be successful in trading synthetic indices, right? So how do you master technical analysis? There's a 4-step framework, 4-step process. You only need 4 steps to master technical analysis, because the problem that most traders do is they want to learn everything. They want to learn trend lines, indicators, Fibonacci tools, rectangles, chart patterns, candlestick patterns, RSI, everything that is there to learn, right? There's a lot of information about technical analysis simply because people are inventing new ways, people are inventing new indicators. Programmers are just building indicators to help you in the forex market, but that doesn't mean that you have to learn everything. But what you need to do is master only 4 things, and these 4 things are simply explained in this video popping up on the screen right now. I don't know if this is this side or this side, and this video is going to show you the 4-step framework that you need if you want to master technical analysis and start making money with synthetic indices. So go and watch that video right now as I'm signing out, and I'm gonna be seeing you in the next video. But let's meet on that video as I'm explaining to you what is it that you need to master technical analysis. Thank you.